Hello once again, options traders, and a big good morning to everybody out there. And for everybody who knows me knows that I'm a very big fan of option pricing relationships and pricing boundaries. And yeah, I know sometimes people think, that seems so cut and dry and so academic. Why do we need to know them? Well, people who think that are really missing the point. If you understand where your option prices should be, this boundary space, and some of the relationships between strikes and expirations, you're going to find that your strategies start to fall into place. It becomes a lot easier to figure out when things are going to get maxed out, when they're minimized, when risks become dangers. And it all begins with understanding pricing relationships. Now, there's a lot of them out there. I've talked about them before in previous videos, but let's take a look at another one, sometimes called a three-strike option relationship. What is it, and how does it work? Well, I'm going to start by posing a question, and this relationship works for 3 calls or 3 puts. Take your choice, the relationship works, but it's either got to be for all calls or all puts. Now, these options are identical except for the strikes. That means they are the same underlying stock and the same expiration. We're just looking at 3 different strikes. So for this video, I'm going to just pick some, let's say the 95, 100, 105 calls. Now, it turns out that they don't necessarily have to be equally spaced like I have them here. In this example, I have them $5 apart here on the left side and $5 apart on the right side. So again, that doesn't necessarily have to be true, but the rule will break down. That's a separate video. But for right now, let's look at as if they are symmetrically spaced. And when we see this, what can we say about the center strike, in this case the 100, compared to the other 2? What's the relationship here? Well, it turns out that this center strike has to be less than or equal to the average of the other 2. So the center strike must be less than or equal to the average of the remaining 2, whichever they are. Now again, in this video, we're assuming that they're all equally spaced. So in this video, we're just talking about those 2 ends. Let's call them the bookends. And that center strike has to be less than the average price of those remaining 2. So to see why, let's take a look at an example from a pricing model. And I used 30 days to expiration, 20% volatility, and no interest rates. But it doesn't matter. Just pick 3 option prices. And I put the stock at 100. The $95 call was worth $5.56. The at the money $100 call is worth $2.28, and the 105 out of the money is worth 64 cents. So what this relationship is saying is that this center strike right here in green has to be less than the average of the 2 outer ones in red. So for instance, if we take 556, that's this top one, plus 64 cents, the bottom one, we add them up, we divide by 2, we get 310. And notice that 228, that's our center strike right here, is less than or equal to 310. And that will always be true. At best, they'll be equal, but for the most part, it's going to be less than. So again, because of this inequality, we can also look for the maximum values. So if we look at these same option prices, remember it says that our center strike here at 100 has to be less than or equal to the average of these 2. So again, if we look at the average is $3.10, that means the very best or the very most that this $100 call could ever be worth, assuming the 95 and 105 calls stay at these same prices. The most this call could ever be worth would be $3.10. Now, if it happens to break that boundary of $3.10, there's what's called an arbitrage opportunity. I'm not going to go into the details of it, but that's how we know that it has to happen in the real world. So to give you a little bit more of an insight why this has to happen, let's jump over to an Excel spreadsheet and take a look at it graphically. All right, so here is our Excel spreadsheet, and I've got 3 different strikes. Here's our 95, 100, 105. And to make it easier, I'm going to list the option prices at expiration. So we're going to compare 2 traders. Now, trader number 1 is going to hold the 95 call and the 105. These are the outside ends, the bookends right here. He's got 1 of each. And so these would be his payoffs at expiration. we're going to compare him to a second trader who is going to hold 2 of the center strike, 2 of the hundreds. And at expiration, these will be the payoffs. So notice that they're equal for all of these stock prices at 105 or higher. But if the stock climbs above the 95 strike, that's this lower one, for trader number 1, it starts to gain value. Well, this guy has no value, and this is really the trick. So here are the 2 graphs. In red is the second trader who has 2 of the $100 calls. The trader in green is the trader who has the 95 and the 105s. So notice what's happening here. As the stock starts moving up, it hits 95, trader number 1 has an option that's going in the money. 1 contract, and that's why he's got 100 deltas here going off. But notice as he's making money, trader number 2 isn't making a thing. That's why his graph is flat. And that's because he has 2 of the 100 calls. However, once the stock hits 100, trader 2 now has 2 calls, so it has 200 deltas. So notice that this line is steeper right here in red compared to the green. But once we hit a stock price of 105, which is trader number 1, that's his outer strike right here at 105, he now also has 200 deltas. And so that's why this green line joins the red. They both have 200 deltas for all stock prices above 105. So what do you notice? That the green line always sits above the red line. It's superior to the red line unless the stock is down here at 95 or below, in which case they're equal, or if the stock is at 105 or above, in which case they're equal. But the trader here in green, the trader who has the 95, 105 calls, can never do worse. And that's really what's making this principle work. So keeping these points in mind, let's go back over to the presentation and find out why the center strike has to be less than or equal to the average of the outer 2. All right, so in that demonstration, we looked at trader number 1 who owned the 95 and the 105 calls, 1 of each. And we compared that trader to a second one who held 2 times or 2 calls of the $100 strike. So notice that the 95 plus the 105, that's trader number 1, was greater than or equal to 2 times that of the $100 call. And that's what we saw in the Excel spreadsheet. And so if you just look at this algebraically, I could divide both sides by 2, and that's the same thing as saying that the $100 call must be less than or equal to the 95 plus the 105 divided by 2. And that's what makes this the average. So we know that if you have 3 calls in a row, 3 different strikes, doesn't matter what they are, and if they're equally spaced, that center strike has to be less than or equal to the average of the other 2. And by average, I'm again talking about their market prices. So if you're new to options, like it's so true, and so many times in math, people go, what in the world do you need this for? Trust me, it will pay off big time once you start learning strategies, because that's going to allow you to see what makes the strategy tick and to understand these option pricing boundaries and what happens when they get crossed. And if you understand these, it's going to make it a lot easier to learn your strategies, your hedges, rolls, and morphs. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.